So let's talk about gold. It's so much more than just a shiny metal. It's a really serious financial tool, but one that gets misunderstood a lot. Is it just some relic from the past, or is it actually a vital part of a modern investment portfolio? Okay, let's dive right in and figure out what really makes gold tick.
At its heart, the appeal of gold really boils down to this one powerful idea. For literally centuries, it's been seen as this reliable store of value. It's what people flock to when other assets start to feel shaky. It's like a gilded shield against economic storms and all that uncertainty.
So that begs the question, right? How does this ancient metal fit into our super modern, super digital economy? Let's take a look at why gold is still such a major player on the world's financial stage.
Yeah, you can forget about the treasure chests and pirates. The biggest players in modern finance today, well, they're not just holding gold because it looks nice. They are using it for very specific, very strategic reasons that have a huge impact on the entire global economy.
So who are we talking about here? Well, central banks, for one. The huge institutions that manage entire national currencies. They are major holders of gold. And they, along with tons of private investors, use gold to protect their wealth. It's a way to diversify away from what we call fiat currencies. That's just government-issued money, like the US dollar or the euro, which, as we know, can go up and down in value.
Okay, so if gold is a shield, you have to remember its effectiveness isn't static. Its price is always changing. So what are the forces that are constantly pushing and pulling on the value of gold?
First up, there's inflation. When prices are on the rise, your money just doesn't buy as much as it used to. Historically, this is when investors have turned to gold, because they see it as this tangible thing that holds its value better than cash. Just look at the high inflation of the 1970s. The price of gold absolutely skyrocketed.
And then you've got interest rates. Now, this one is really interesting, because when interest rates are high, other investments like bonds suddenly look a lot more attractive, right? Because they pay you an income. Gold, on the other hand, doesn't do that, and that can make it less appealing in comparison. So you often see this relationship. When interest rates go up, the price of gold tends to go down.
And, of course, global instability. During times of crisis, say a war or some major political mess, investors get nervous. And what do? They sell off their riskier assets and move their money into things they see as safe havens. And you guessed it, gold is usually right at the top of that list.
So the bottom line is, it's a pretty complex dance. You've got inflation and interest rates pulling one way, global crises and currency movements pulling another, all on top of the basic economics of supply and demand. It's a lot to keep track of.
All right, so we get the why of investing in gold. But now let's get practical. If you actually wanted to add this gilded shield to your own portfolio, how would you even do it?
Generally speaking, there are two main paths you can take. The first one is physical, literally owning the metal itself. You can hold it right in your hand. The second path is digital, where you buy a financial product with just a click, and that product represents ownership or exposure to gold. And this really breaks down the options perfectly. For physical gold, you're talking about classic bars and coins. Sure, you have to think about storing them, but you have direct ownership. On the digital side, you've got more choices. You can buy shares in an exchange-traded fund, an ETF. Think of it like a giant fund that owns tons of gold, and you're just buying a small piece of it on the stock market. Exchange-traded commodities, or ETCs, are pretty similar. Or you could go a different route and invest in the companies that actually mine the gold. That's more of a bet on the industry itself, not just the metal's price. Every single path has its own set of risks and benefits.
Okay, now we've arrived at the most important question of all. Because look, knowing how gold works is one thing, but knowing if it actually fits your personal financial goals, that's a whole other ballgame. So let's break down that final decision. Here is the fundamental trade-off. It's really simple. On the one hand, gold can give you excellent diversification. That just means it often moves differently than stocks and bonds, which can help smooth out the bumps and reduce the overall volatility of your portfolio. But, on the other hand, it completely lacks income. A bar of gold isn't going to pay you dividends. It won't pay you interest. It just sits there. So with that big trade-off in mind, who is the ideal person for this gilded shield? Who should be looking at this?
Well, the profile is actually pretty clear. Gold is typically for the long-term investor. It's for someone who is way more concerned with stability and protecting their wealth from inflation than they are with trying to make a quick speculative profit. It's really all about balancing risk over the long haul.
So, we'll leave you with this thought.
Gold is not some magic bullet to get rich quick. It's a strategic tool. It's for preserving wealth and managing risk. And in a world that seems to be filled with more and more uncertainty, the real question you have to ask yourself is this: does your portfolio need its own gilded shield?